All right. Welcome back to the Educated Homebuyer, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. So, Josh, this week we've got consumer confidence coming in at a 16-month low. We also have Fed Powell coming out today, basically saying that the Fed needs to, what did he say? Needs to accept higher inflation risk to combat, recession risk to combat inflation. With the PCE, we got PCE coming out tomorrow.
Tomorrow.
Still a little bit of volatility in the market. The consumer confidence had an impact on interest rates earlier in the week, which we'll talk about here in just a minute. But let's talk about the idea of the Fed driving us into a potential recession, right? That's the title of the video this week. We'll take questions after that. We'll talk about real estate and mortgage, which is why many of you guys are here. But Josh, the Fed came out today basically saying that, which honestly is probably, in my opinion, a positive thing that he's come out and acknowledged the fact that, hey, listen, inflation is our priority. And that's essentially what he said. It's our priority. And if what we do drives us into a recession, then so be it. I mean, that's more or less what was taken from that statement, or how I read it. So how do you feel about that? Are we in a recession now? What does this mean for housing? Let's talk about it.
Well, it's kind of just stating the obvious, right? Anyone watching knows, you and I were looking at a couple things earlier. No one wanted to acknowledge in the first quarter, there was some weird stuff and some rebalancing of inventories. So GDP was low, but as the numbers are revised, it's going to get revised higher, and will probably be slightly positive for the first quarter. It didn't. Every revision got slightly worse. We ended up with like negative 1.6 growth for the first quarter, and it was largely due to inventory builds. But that was.
I'm gonna stop you real quick, Josh. Your mic sucks. I think we're on the wrong mic.
It's not on the wrong mic. I just checked it because you sounded weird to me.
Yeah. Okay. Well, keep going then.
Well,
let's get you talking
one more time. No, it's on the right one, and I have no idea.
It sounded like it improved, but nevertheless.
All right.
So revisions happened with regards to the first quarter GDP.
Yeah, and it was negative largely because of inventory builds. But should inventories have been building? Remember, the story in 2021 is supply chains are constrained. No one can get supplies. So retailers bought a lot of stuff to put on the shelves to rebuild inventories right at about the time when people started buying less. A couple of reasons for that: stimulus is wearing out. People were focusing more on savings, and that was when inflation really kicked up. In addition to first quarter, we had the Russian invasion of Ukraine. So a lot of uncertainty. So when you look at consumer confidence, I always take consumer confidence with a grain of salt, because it's very dependent on inflation reads, employment reads, and stock market numbers. So we've seen stocks and crypto way down. So you have a negative wealth effect. People start feeling negatively, even though that's not necessarily correlated to the direction of things moving forward. But what it does correlate to is how people spend. So if they're feeling negatively about the near-term future of the economy, they're going to spend less, and that leads to, again, lower GDP. So you and I were looking at the Atlanta Fed does something called their GDP Now estimate, which they plug in every number that comes out every day. They revise it. So it's a noisy number. It bounces around a lot. But what we can look at is, despite the ups and downs.
Do you want to throw that on the screen? Can you throw that up? So we can all take a look at it?
Let's give it a shot here. So share screen, Chrome tab. Here we go. Okay, so this is the chart right here, and there's two things. You see this blue wave? This is you can't read it because it's so freaking tiny, but it says blue chip consensus. So every major investment bank, they put out their number of what they expect GDP to be. So the blue line is the average, and the blue bar there is the range of what people are expecting. So you can't see the numbers, but the bottom of it here is about 2%, just below that, and the top is up at about 4.5%. So blue chip consensus is right around 3%, and it's been tailing up here for the last few weeks. Well, interesting, right? So we look at the actual number from the Fed, and they're not forecasting. They have a model. It's basically an algorithm that takes all of the information and it looks where we're at. So as I said, it's super noisy. You can see here, jump up, down, up, sideways, big down, back up. But if we were to draw a line through here, that trend is lower and lower, and that is zero. We hit zero, what, June 15th, around there. And as of today, we're at about 0.2% growth. So the Fed's own numbers, their own algorithm that they're looking at, is saying there's a very good likelihood that we have close to zero, if not negative, GDP growth in the second quarter. Well, the classic definition of a recession is 2 consecutive quarters of negative GDP growth, and we never know when it starts and when it ends. It's usually about a year afterwards that they actually go back and declare it. When all these numbers are
Yes.
finalized, they go, okay, here's where it started, here's where it
As
ended.
we're coming out.
Yeah.
As we're coming out of the recession, they're declaring, hey, we were in a recession.
Hey, guys, in case you didn't know it.
Yeah.
And if you look, again, I say this with all respect, but look in the comments here. There's always crazy outliers either way. That people are super pessimistic or super optimistic. But we see a lot of this. People saying, "I think we're in a recession now." Normal people, not people that are crazy, out on the tail ends of the bell curve, yelling into the void. I mean, normal people saying, "Hey, I kind of feel like we're there," and not saying it in a horrific way. Obviously, we're not in a terrible recession. Unemployment is still really low, even though it's trending up. Inflation is uncomfortable. So we're having inflation and we're having a downturn in stocks. So for most people, they're feeling a little bit of a squeeze. Home values are up, home equities are really high, record high level. So with that, people from that perspective are feeling good. So there's something to feel good about. There's some things to not feel good about. And that's why these numbers are trending down. And if you look at it, Jeb, let's just go back to what the Fed Powell Chair Powell said today is, well, we would rather weight our risks toward recession than letting inflation on. And that's obvious and rational, but it's also crazy to continue talking like they can do that and stop magically short of pushing us into recession. I'm not saying it's going to push us to a super deep recession. We're going to have -2, -3% GDP growth, but we're probably going to have 2 negative quarters. If it's not here in the second quarter, it's going to be sometime here later in the year because they're committed. You saw Jeb, one of his quotes. I don't have the exact quote here. The markets are forecasting another 1.75% of Fed hikes between now and the end of the year. And he said, our objectives are pretty much in line with market expectations right now. So he doesn't think that they're that far off. If they raise another 1.75, they guarantee a recession. So
No,
that.
and so the reality is yes. I mean, the answer to this question is yes, we're heading into a recession. What does that mean for housing? We're going to talk about that here in just a minute. But something I want to point out, right? Josh and I, pretty bullish on housing. We think, home ownership is important. I think you get that in watching the channel. But we also try to speak to you as a buyer and saying, hey, listen, it's not always a great time to buy. Unless you kind of, it's the right time in your life, you have the time horizon, money in the bank, all that good stuff, not stretching yourself. But what I want to point out here is that in a market that is stabilizing, decelerating, if you will, which is what we're seeing, home prices not appreciating at the same level they were 3 to 4 months ago, it's confusing when you start to see data that, for example, Case-Shiller coming out and saying that there's a 20% year-over-year increase in prices. Well, Case-Shiller is looking at data from February, March, and April, I believe, are the 3 months that they're looking at that data. Well, February, March, and April, the homes that closed during that period of time went into escrow in December, January, February, maybe even November, December, like sometime a couple of 30, 60 days prior to that data coming out. So you look out there and go, okay, home prices are still increasing, but I'm not seeing it. This is garbage. Well, the data is lagging. It's not actually keeping up with the market, right? The market has changed with rising rates, with affordability. And the reason I point this out is the market's not crashing, but when you look at that data and then you go look at your market, there's some confusion. Well, you have to understand why there's confusion. It's the data is, I mean, at this point, when you look at Case-Shiller, is 5 to 6 months old to some extent. So just know when you're looking at that stuff, and that's why you see some discrepancies in days on the market, and you see some discrepancies in how this stuff is put into headlines. It can be confusing. So it's all the more important to work with a professional that understands your market on the real estate side, on the mortgage side. As you guys know, we have experts in all of those fields and all across the US, in fact. So I'll throw a link up here in a minute so you can get connected to that. But, we're often getting the question, Josh, of what's going to happen as we move through the rest of the year. We actually recorded today. We're a day late on posting our podcast on the Educated Home Buyer, but we posted it today where we give you a mid-year update. What's happened in the market this year, what's happening now, and where we are headed. So if you want to know a true forecast, 30-minute deep dive into what's happening in the market right now, where we see things, after this, go download that, listen to it, and honestly, love to know your feedback on it because it's boots on the ground, what I'm seeing in helping buyers and sellers. It's what Josh is seeing and helping people on the lending side. Would love to know your thoughts on that. So after you listen to it, maybe you can comment on a video. You can come back here and comment, or you can, let us know next week. But anyway, take a look at that. And we are a day late, as I mentioned. So, Josh, something we talked about earlier. We talked about interest rates a little bit at the beginning of the show. Earlier in the week, the consumer confidence numbers came out. The 10-year got hammered at that time because of that. The NASDAQ got murdered on the tech side. And, we've kind of been in a decline with regards to the stock market since those numbers come out, but we've seen some improvement on the 10-year side and on the interest rate side, but there's some hesitation with regards to some of the people that you follow with regards to what happens tomorrow with PCE numbers and the direction of rates to some extent, maybe even a little bit of confusion between the two, because one is saying, one direction and the other saying the other. But anyway, let you probably provide some clarity and help people understand.
Let's start first off by looking at the chart here. And I don't expect this to make any sense or mean anything to you guys, but we had talked about here starting about April, the rates were continuing. So when we see this trend down, that means rates are continuing to get worse. But for the most part, it was sideways here in a range of about 0.5% in interest rate from best to worse.
So on this chart, down, as things go down, that means rates are getting worse, right? It's not interest rate. This is not interest rates. Understand that. And as it goes up, it's the opposite of what actually happens in the market.
And that's why you see the green, the green candles here on the way up. Green we want is good, right? And red is bad. So we were still in this range all the way up right to the beginning of June. We were at the worst parts, but this was when we got that monster CPI figure. And what happened? Bam, bam. And this big gap down.
Like, what's that guy's name? Cook. Bam.
It'll be my catchphrase. I'll steal it.
What's the? I can't think of his name. It'll come to me. Somebody will comment on it here in a minute. Anyway.
There's 900 of them. How do you keep them all straight? But anyways, this gap right here was basically when the market said, people buying and selling bonds said the Fed has lost the plot. They are behind the curve here. And that was when the Fed rapidly comes back in on Wednesday and says, hey, we're not going to raise 50 basis points. We're going to raise 75 basis points. So this move here was hot CPI figure. Markets think that the Fed is behind the curve and not going to control inflation. Once the Fed steps in and says 75 basis points, another 75 in July, which going back to Fed Powell's press conference today, he said 75 or 50. So he's not committed to 75, but leaning towards 75. But what you see is the market has improved since then. It's almost nothing but green candles. So the big one here, that will, this will confuse you because Jeb was saying that's not rates. This is the 10-year treasury, and this is rates. As it goes up, this is yield. So as this goes up, rates are getting worse. So we saw a big red day down here. And kind of one of the things that we look at here is the intraday chart is what happens throughout the day. So again, boring chart here for you, but basically this said all day people were paying more for mortgage-backed securities. We had a little dip of the day, then just all goods, and we ended on the high of the day. So normally when you end on the high of the day, that means there's more buying, more people wanting to push interest rates lower. So we would float because tomorrow we expect more follow-through buying and rates to go lower. The reason why we're kind of hesitating right now is every time we've had one of these inflation figures come out, which tomorrow we're going to get the PCE figure, which is the Fed's preferred measure of inflation. If that thing comes out hot, we could see all of these gains evaporated tomorrow. So for the most part, people can deal with lost opportunity more than they can actual lost costs. So I locked a client today on a purchase. We went through this and they said, no, I understand we could have some follow through tomorrow. My comfort level is here. And all of this stuff, big picture, just tells us, if I just kick back over here, let me get off of that to the big one. We haven't moved a ton downwards, even though the Fed is aggressively hiking. So this tells you, looking forward, that the markets think that inflation is not a big long-term issue. It's obviously an issue right now, but they're not thinking it's an issue long-term. Because if you say we have inflation at eight and change, based off of CPI 8.9, but we have a 10-year treasury at 3.1 as of today. It might actually even be lower than that. Where'd we end up? We end up at 3.08, so at 3.1. So that's a negative return if you believe that inflation figure stays there for the next 10 years.
Right.
As part of the consumer confidence number, Jeb, that you were mentioning, consumers last month said that they think inflation over the next 5 years would be 3.3%. This month, they feel it's going to be 3.1%. The market is telling you in the next 10 years, we think maybe 3.1%, actually lower because they want a return on this. They just don't want to break even. So the market's telling you that they think over the next 10 years is going to be less than that. The question was actually asked to Powell, and there was two other people on the panel, Christine Lagarde from the ECB, and I forget who the third person was, but all world leaders of international banks. And they asked them, are we going to return to the prior period of low inflation? And all of them said, nope, that's behind us. We have inflationary pressures. This is going to be a big deal, which is kind of a crazy answer because Powell also said the other day, if not today, that we do expect in the next year or two to be able to get rates or inflation down to that 2% range. 2% is historically low. That's what the Fed posts.
They haven't even been able to achieve that over the last 10 years.
Exactly.
Right.
And so we ask each other, Jeb, what's changed? What has changed now that you couldn't get it to 2%, and now we're having to fight to get it back down to 2%? Really, the only major long-term change, once the Russia situation comes under control, once COVID gets more controlled, is that both of those issues have ended the long-term trend for globalization. One of the explanations, the reasons for the really high inflation we had in the 70s and 80s is that there was no globalization. So you were subject to monopolies in your part of the world. You were subject to lack of competition, lack of ability to substitute. There's a reason why American cars sucked in the 70s, because there were no Japanese cars. There were very few German cars. So all you're doing is, hey, I just got to be a little bit better than the other guy. And those are the only options for consumers. So what we're seeing now is a little bit of unwinding of these big global supply chains, because that's what's caused problems. So they're talking about, instead of offshoring jobs and production, nearshoring, friendshoring, at least getting it to countries that you have a better relationship with. If you were relying on something produced in Russia and you're an American company, you're in trouble right now and scrambling to figure out solutions. So to me, that's the only thing that's really changed. We still have long-term demographics that are trending down, just like Japan. Japan's about 20 years ahead of us, and they've been not in a deflationary spiral, but a disinflationary period for going on 30 years now. And I don't think anything changes that.
No, agreed. I mean, yeah. I mean, obviously, you and I are on the same page with a lot of that. Got the the viewers in the comments saying it was Emerald. Emerald is the BAM guy. So bam. Anyway, so I had something profound I was going to say there, and then I said bam, and it threw everything out the window. But I know what it was. The Big Short guy, Michael Barry, whatever the guy's name is. A lot of the stuff I feel like he has said or has been commented over the last couple of months is, I wouldn't say irrational, but going out on a limb with some of his thoughts. But, one of the things that he did say in the last couple of days, which I agree with, is that there's a good chance that the Fed ends up reversing what they've done. And, because, like Fed said, his number one goal is to stamp out inflation, basically. And with that there could be cost involved. And could they go too far? And the answer, he said, was yeah, they might go too far on this whole thing. And in which case they have to pull back, right? I mean, we've talked about it, Josh. They ease, and then they slam on the brakes, and it causes, confusion in the market and what have you. And so the future of interest rates, I mean, whether we've reached a peak or we're close to a peak, I think we're starting to stabilize. A lot of the expectations of what the Fed is going to do with the Fed funds rate over the next 6 months, basically the Fed has kind of agreed with the consensus as you stated earlier. So the market's baked that in. So I think the risk of going way higher, in the short term isn't that high, in my opinion. I think if anything, we provide, there's some stability in the market and maybe, just I wouldn't say a pullback in rates, but just, you kind of, wake up and know what you're going to get. I mean, you're not going to see these half point jumps that we saw 3 months ago in the market with the Fed coming out. Now the caveat is inflation, right? If we continue to see super hot inflation, then that changes the mindset of what the Fed does. I think at this point, the Fed raising the Fed funds rate more aggressively in the short term actually benefits the market long term to some extent. Now, Josh, you want to comment on that or just dive into
No, I think you're 100% correct on that, and I kind of wanted to throw this up here. This is really a comment. Winnie the Pooh in EOR2 says, "I read mortgage rates will go over 7% by the end of the year." There are a lot of people out there saying a lot of things, but tell me why. Tell me what mechanism is there to cause it. Could it happen? Yes. If it were to happen, why? The Fed backs off of their plans and the markets don't like that. They lose confidence in the Fed. Don't think
sure.
that's super likely.
No, but they could.
Inflation stays high and or accelerates. Okay, it could happen. What would have to happen to cause that? We none of us saw Russia coming, so there are things that could happen. You could have, let's say we get to the fall and a really big outbreak of COVID. We find out that vaccines didn't work and it's worse than anyone ever thought. All
That
of
won't
those
be good,
things,
people.
it would not be good, and
It would
all of
not be
those
good for
things
housing.
can happen. So
Yeah.
from that perspective, can it happen? Yes, but you have to believe that the markets are wrong. And Jeb, let's not always say that the markets are right. I mean, a year ago, Bitcoin was at 60,000. Less than a year ago, 7-8 months ago, Bitcoin was at 60,000. That's a market. That's the wisdom of crowds. That's a group of people who agreed, hey, 60,000 is reasonable, and now it's at 20,000. So it doesn't mean that the markets are right. But I always defer when we're talking about bond markets. Bond markets are much more conservative. Most people don't invest in bonds. It's institutions and professionals. So when you look at that and they're buying and saying, hey, yields at 3.25, yields at 3.5 are attractive. And think about one of the reasons why that is. Why is there a floor under bonds at that price? And treasury bonds and mortgages are not exactly the same. Again, we've talked about spreads between treasuries and mortgages for various reasons are bigger than typical right now, which is to be expected. But why are there buyers in treasuries at 3.25 to 3.5? The average yield on a dividend yielding stock is like 2.5, 2.6%. So you're getting a bigger yield and you have some potential for capital appreciation if yields come down. And you don't have the risk of the stock market dropping another 10, 15, 20%. So for that reason, we're kind of seeing a balance. There's a reason why the selling in treasuries has sort of backed off as we got up above 3%. And that floor or ceiling, I should say, in yields is somewhere between 3.25 and 3.75. So that tells us that the interest rate should be 6%ish, should be somewhere near our ceiling. Not to say that it is, not to say, hey, Josh and Jeb said rates are going to go lower through the rest of the year. They're likely to, but that's the things that we would look at and what would have to happen for rates to go higher.
And here's what I'll say about a lot of people saying anything. There's been a lot of people talking about a housing crash since 2012. Well, guess what's happened since 2012? Home prices have appreciated 100+%. So if you want to go, with what people are saying, people, do your homework, understand economics, understand what goes into it. Could they be right? Sure. The probability isn't very high. And everybody wants to talk about history repeating itself. Do your homework. Look at what history tells you about recessions, what it tells you about when the Fed hikes interest rates, what it tells you about long-term price appreciation in home prices, and then you could say, well, history doesn't repeat it. Well, okay. There's always going to be two sides. We're not here to convince you. I've decided that that's me beating my head against the wall trying to convince someone. The reality is those that listen and understand, and it's the right time for them, we'll create long-term generational wealth, and those that don't will continue to rent. So with that being said, Josh, you look like you wanted to say something.
Hold on, my friend. I do. Exactly what you were talking about. Be careful of people who don't bet with their money. They just bet with their mouth. I believe this. I think this. The market's going to do this. Okay. Do you own any shares of that? Do you own any Bitcoin? Do you own any real estate? No. You just read a lot and talk a lot? Okay. Because I can tell you, I have 5 pieces of real estate. I should count. Yes, 5. Not selling any of them. Not worried about any of them, not expecting anything like appreciation from the last couple of years. And what I would say, you guys have heard me tell the story of the family, my wife's friend, who they bought literally at the peak. And they said the things that Jeb and I talk about all the time. We don't care. We're going to be here for the long haul. We don't want to rent anymore. We're going to build up wealth. And now the home that was upside down by a couple $100,000. So it's not the optimal way of doing it, but the home that was upside down by a couple $100,000 at one point, they now owe $275,000 on, and it's worth $1 million, $1.1 million. So sitting on the sidelines, listening to other people who don't own any real estate tell you what's going to happen with real estate is insane. Look at what people who own real estate are doing and think, again, you guys probably heard me talk about, there's a book, Annie Duke, the poker player. She has a PhD in psychology, I believe. And she wrote a book called Thinking in Bets. So if someone tells you, I know this for 100% fact, cool, will you bet me $1 million? And watch how quickly they backpedal. Well, no, I wouldn't bet $1 million. Well, I thought you were 100% certain. People who aren't betting with real money and investing their money are not the people you should be listening to.
Enough said. So now we're going to move on to happier times, and happier times in the sense that you guys crushed my drinking caffeine on here. Everybody said I was going to die of a heart attack. I'm being facetious here. So in turn, Josh decided to get me Topo Chico ranch water. So we're looking for sponsors for ranch water now. We didn't get sponsors on just regular water. Nobody wanted to give me H2O. In California, I get it because we're in a drought. People can't afford to give me regular water. So I decided to go with caffeinated water. You guys said that was going to kill me. So now we're going to go with alcoholic water. That's what we're trying to get sponsors on. So anybody out there that wants to sponsor us for alcohol, give it to us. Now we've got Naked HD Tender overpriced stuff in our chat here. Jennifer Lego is canning that. So thank you, Jennifer. But let's talk about what's actually happening. Why you guys came here. You had some questions. So let's talk about questions. So Mirlati? I have no idea.
I go with Merlot.
Merlot.
It could be Merlot. Maybe her mom was a wine drinker and just spelled it differently.
Possibly. We're looking at sponsors. I'll take a Merlot sponsor.
We'll take a Merlot sponsor as well.
Yeah. But the question is, can foreclosed homes be financed with a mortgage? In most cases, the answer is yes. But understand if that property is distressed in the sense that it needs a ton of improvements or that there's major work to be done on that property. In some cases, those properties can't be financed with conventional financing. There are types of financing out there that allow you to do rehabs on properties, which we're not really going to dive into now. But the easy answer to your question is yes, foreclosed homes can be financed with a mortgage. But understand, somebody commented today on a video, and I actually had responded back, talking about, hey, there's a bunch of foreclosures coming or are happening right now. Understand, any foreclosures that are happening right now, the large majority, I don't know what the actual percentage is, but it's the greater majority, are homes that were in distress prior to the pandemic. So they're not people that have bought since then. They're people that were in trouble prior to the pandemic. So foreclosures, people, they're not happening in any mass. In our market here in Southern California, if you're in a market that has more distress sales, pay attention to it. But for most of the United States, you're not going to have those.
And on this subject, everything Jeb said is 100% correct. Think of it in these terms. The lender can almost be financed with a foreclosed home, be financed with a mortgage. The lender only cares that there is a valid seller on the other side with the authority to sign the deed and enter into a contract with you. So on a foreclosed home, instead of an individual that owns the home on the other side, it's a bank, it's a hedge fund, it's a mortgage servicer. So no problem whatsoever. Loan will function exactly the same, other than a different group of people signing on the other side, other than if you get into stuff like Jeb said in terms of the condition of the property.
So we've got some questions that are outside the box. First off, I'm going to put Steven up here because Steven has been a long-term viewer, but Steven bought a house when rates were low, and Steven is thanking us. Now, we didn't do that for Steven,
Steven did
but
that.
yeah, he did that. You made that choice, but you paid attention to what the market was doing, and it made sense to you. And since then, you've locked in a super low rate. So congrats to you. But here's a question, Josh, something that we don't get often, and I'm going to go a little bit out of queue here and throw this one up here. Randy says, mother took out a reverse mortgage against my advice. Does mortgage interest accrue just like a regular loan?
Exactly. Except there's no payment made on it. So the interest that's due every month gets added on to the loan balance. And probably the bigger picture thing here, nearly every child of a elderly parent who wants a reverse mortgage says absolutely not, don't do that, they're terrible for a million different reasons, and most of it are misconceptions. To do a little market research myself, my father-in-law just turned 70, I want to say. If he's watching, he may be younger than that, he may be mad at me, but he's in that age group. His friends are in that age group. They're all retiring. So I asked him, not that he was going to take a reverse mortgage, I said, what do you know? What are your thoughts? Nearly everything he told me about a reverse mortgage was wrong. Primarily, people think that you're giving up the property, that when the owner of the home passes away, the bank gets the home. They don't. It's a mortgage like any other mortgage, except for you don't make a payment against it. So if you owe $200,000 and the interest is $1,000 a month, every month now you owe 201, 202, 203, and that's a normal lien against the property. And you have 180 days when that person, there's a fancy word for it in the reverse mortgage world. It's like a qualifying event, which means either moving out of the home, if they had to leave the home and move to a care home, if they passed away. Within 180 days of that, you have to pay the loan off. So you can sell the property and pay it off. You can refinance the property and pay it off. But there are a ton of misconceptions about reverse mortgages. They are not terrible. They are less well regulated than standard for forward mortgages, and more room for people to sort of take advantage and make more money than is necessary off of our seniors that own homes. So they're a good tool when used appropriately. So do your research, help your parents, grandparents, aunts, uncles with their research. But the answer to the question is, yeah, it just accrues interest. You just don't make a payment on it. And if you wanted to make a payment on it, you can. And some people, for retirement planning purposes, do take out a reverse mortgage and make at least the interest payment every month to push out that accrual of the loan balance.
No, good stuff. Another solid question here. Daniel asks, if you were in our shoes, would you buy today? Would you buy today, and why? So interesting story. So in the last week, there's been two properties that have come up in our market that my wife has sent me that she's interested in. And we're in a point in our life where it makes sense to buy another property. 3 kids, 3 boys,
Rapidly growing boys.
But yeah, between the ages of 4 and 10, a lot of energy in the house, and we need more space, quite frankly. The caveat is I bought my house for $500,000 back in 2012. And with that, I'd really like to keep my property because, for one, the cash flow, if I rented it out, would be extremely positive because my interest rate is in the 2%, in the high 2%, 2.99%. So for me to buy the next leg of house that I need to accommodate my family in the market that I want to be in is over 3 times what I paid for the house that I have now. And we're considering it. We're considering buying that property. But here's the caveat is because of where I bought my property and the interest rate I have locked in. Now, keep in mind, I don't have to do anything, right? My family will be fine in the situation that we're in. We're not, it's not going to be, the kids will grow, right? They're not going to stunt their growth by being in a 1,800 square foot house versus a 27 or 2,800 square foot house. So with that, we're considering it. The caveat is my payment jumps considerably to do that. And so for that payment to make sense means I have to sell the property that I'm in, which takes me away from really the goal that I want to accomplish in keeping that piece of real estate. So the easy answer to your question is yes. Yes, I would absolutely buy in this market. And honestly, we're considering it at a much higher price point. But at the same time, I'm like a lot of sellers. I don't have to do anything. I'm really comfortable with my monthly payment. I'm really comfortable with the amount of equity I have in my property. So, do I sit and wait and just own this piece of real estate forever and take my money and invest out of state? Because that's also something I'm considering doing. Looked at a property last week in another market that I've talked to you guys about here. By the time we were making an offer, it was already in escrow. They accepted an offer prior to when they said they were. So I'm looking to buy real estate, but I'm also looking to make, the right decision for my family based on the right property. So, these are both great properties, but I don't know that they're the perfect property for other reasons. So I can be a little bit more picky. But the answer is yes. And Josh, you bought a property. I mean, it was a different market, but you bought a property during this whole boom. But you bought it at a distressed value. It had opportunity for equity gain. And guess what? You had an opportunity to sell that property and probably cash in $200,000 or $300,000 in equity, but you decided to keep it and turn it into a rental. Why? Because rental prices are continuing to increase. It made sense to go up, and I mean, it made sense because the rental values were going up, and also the idea that it could continue to appreciate further. Aaron?
Absolutely. And it has. Like when we looked at it, we're at the end of it, we're like, hey, there's a nice profit in here, but it's sort of like eating the goose that's laying the golden eggs. It produces positive cash flow. So let's say it's less. It's about 15% positive a month. So it's about $500-600 a month positive. So it's $7,200 in a year. Now, if you get a crazy tenant, they can do $7,200 of damage pretty easily. We have a security deposit of $3,500. So let's say we get a $10,000 cushion. I don't consider that positive cash flow. I don't go out and spend that money. That money just accrues in the bank account for that property. But I said, I have a property that pays for itself, which includes about $780 a month of principal reduction, which increases every month. So these things apply to you also in terms of buying a home. So every month that goes up. And within probably 2 or 3 years, I think it was up over or close to $1,000 a month of equity accrual just through principal paydown if the values stayed level. Since we chose not to sell it when it was done in the fall, that market value has gone up another $50,000, $75,000. So if it drops, will I like it? No, I won't like it. But do I care? No, because we've decided that the cash flow of that property, someone else making the payment, me not having to feed it, and that principal reduction over time is going to build wealth for us without me having to save it. So when I asked, I saw the question also, Jeb, and like this is probably, we could just answer this question today. This is the best question of the day, because if you do not own a home, the question is, do you buy? And we go back to the things we talk about, not because, hey, it's fundamental and this is so easy and hey, duh, this is what you look at. If you are not really stable in your life, if you can't say with a very high degree of certainty that the home that I buy today, I would be happy living in for 5 to 7 years and unlikely to move, I wouldn't do it.
No.
But for me, I haven't moved from my home in 19 years. I haven't moved from my area in 41 years. So I am going to live in this area. I want to own a home. So take away all my real estate. Say I don't own. If I had somehow gone through the last 2 years, it's not a fair question for you guys to ask because I'm in the business. I would not have gone through the last 2 years without buying. But if I did, if it was me single, yeah, I would buy a property and I would look for something different than what you guys are looking at. I would look for a distressed property to buy at a discount to rehab to get in. I would absolutely be buying, but I wouldn't be looking at getting rich quick. I would say, as part of the podcast this morning, Jeb and I went through the numbers. 75-year average of home price appreciation in the United States of 4.6%, much higher than that in California. I would expect and plan for the next 10 years to be less than 4.6% because we just had two of the most insane years ever. Things revert to the mean. Do I expect that 4.6 number to hold or something above 4%? Yes, I do. But we can have some below trend years and still hit that number over the long haul. So hopefully that answers your question. I would absolutely buy if I weren't in the market as long as it made sense in my life.
Absolutely. And that answers this question that Merlot had about buying a fixer upper and fixing it as opposed to buying a newer home. That's it. I mean, Josh kind of answered that. But in any market, you just have to understand like people have a false idea of what it costs to rehab a home, to fix it up and sell it. I'm sorry, to fix it up and live in it because of all the reality garbage that's out there where they post a kitchen remodel and it costs them $5,000 or set. That's not real. So if it makes sense, if you have the cash to do the rehab to make it your own, that's always a better option if you can get the property at the right price. But over the last 2 years, what we saw is the properties that needed the work and the properties that were remodeled, there was very little variance in those two numbers. So it made sense to buy the one that was fixed up already because it made more sense. So it to each his own on the scenario. But I would say, yeah, if you can find a distressed property or a property that needs some work, you can put your money into it. It adds the value there and you have the cash to do it, sure, why not? I think that's a win-win in many ways. Now, the idea of, Josh mentioned a moment ago about, not buying now, like, the thought of buying a property at the moment, that the idea of that property declining doesn't come into my mind at all because I'm in real estate. I understand real estate. If I buy that next property, that to me is probably not a forever home, but it's a home for probably the next 10 to 15 years. That's important, guys, because that's a longer term time horizon. And I'm focusing on, again, being there long term. But more importantly, what I'm focusing on, the monthly payment. Can I, in a potentially recessionary environment coming up in a market where things slow down potentially, can I continue to make that payment? And for me at that price, yeah, I can. The question is, do I want to? Do I want to be, I won't say house poor, but do I want to have to worry about a housing payment? That's what you have to, think about in this market, right? Is not only can I afford the payment, can I continue to make that payment? Do I have some money on the sideline if things don't go where I think they're going to go? What if I get laid off? Do I have some reserves? All things that you have to consider when buying a house. And that's even the case in a market that's appreciating. You still need to ask yourself those questions. But Josh mentioned something really important about how much we've increased and how far we are above the, I say 60 or so year trend of 4.7% appreciation. We're pretty far above it. So there is a chance that housing prices pull back. There is a chance that we get some stagnation with regards to the market and things don't, appreciate and whatever. Are you okay? I mean, if you're planning on selling in a year, which somebody asked, a question about, and I'll post here in a minute, are you going to be okay in that scenario? I don't know. And I wouldn't want to find out, right? I wouldn't want to be the person that's buying now and having to sell in a year, not because I think the market's going to crash, but it's going to cost you 5 to 6% to sell your house. I mean, that's the reality. So if you bought a house and you put 5% down and you purchased that home and the house prices didn't move at all, they stayed the same, it just stagnation in prices for the next year, and you go to sell that house, chances are you're just at a break-even point because you put 5% down. It's going to cost you 5 to 6% in many markets to sell that property. You've paid down the principal a little bit, but you're not making, there's no money being made. And if you're in a market that does see a decline in property values, 5, 7, 10%, over the next couple of years, which I don't know what the likelihood of that happening is, but it's going to happen in some markets. You're going to be in a position where you're either stuck in that property and you can't do anything, or you have to short sell it. And that's what the fear in the market is. And I get it. I understand it. But you can't make decisions based on fear. When your grandparents purchased their house 60 years ago, they never thought, hey, is my house going to be worth, $19,000 next year? They thought, hey, can I continue to make this $100, $150 payment or whatever it was on the mortgage?
$87.
And I'll be honest, like I have conversations with people all the time where they tell me, they were like, you know what? When I bought this house, I had no idea how I was going to make the monthly payment. I was scared to death. And trust me, you shouldn't go into a house with that concern. That was something that was a long time ago, but they were never focused on the price of their property. Why? because they needed it for their family. They needed it for what was going on in their life. They wanted something to own. That's why you should buy a house. So a long way of getting around to a bunch of questions that were asked there, but hopefully that's helpful.
But hold on, Jeb,
Yep.
you a lot of great information there. But back to her question was, would you buy a fixer or would you buy something turnkey? And we talked about this morning in the podcast episode. I am not just continuing to pitch it. We both felt like when we were done, like there was a lot of really good information there. So
I think that's the best podcast we've recorded. Honestly.
I would say go back and listen to it. And one of the things that we talked about in a normalizing or a cooling market, one of the things that we're going to see the last few years, a home that needed $50,000 of upgrades to be whatever the par is for the market was getting a $10,000 or $15,000 discount. So people were like, oh, good for me. I bought low for the neighborhood. But by the time you put the $50,000 into it, you're actually at a worse off position than someone who had bought a turnkey home. Now we're seeing a normalization. There are less buyers out there. So it can be more advantageous. You, instead of getting, if the house needs $50,000 worth of work, you want to get it for a $60,000, $70,000, $80,000 discount. So that's the first equation that you want to run there. Is the discount greater than the realistic number that it takes to bring it into the standard for the neighborhood? Now, there's some intangibles there. You get to do it the way you want, to your style and current today, not 2 years, 5 years, 7 years ago, whenever the current owner did to that home. The other piece that you got to take into account is, are you handy? And I mean truly handy. You can do some of the work. This guy right here is the least handy person in the world. So I have to look and say, what are contractors, handy people, charging to do this work in the current market? And what are materials costing? Materials costs are still elevated. I think for the most part, contractors are still busy, not as insane as it was, a year or two ago, but they're still busy. So you're going to pay a premium for your contractor. You're going to pay a little bit of a premium for your materials. So you want to make sure you're getting that discount on the way in, and know yourself. Am I handy? I'm going to do this work myself. And don't bullshit yourself to say I'm handy when you're not. If I told you I'm handy and I can redo a kitchen, I can demo a kitchen, that's the end of it. I can't do anything
even do that,
there.
bro.
I've demoed many a kitchen in my life.
So Chelsea's got a question here. Could you do a video about selling your house after 1 year? So I think any video, like, go back. I have talked about this. If you're selling after a year, well, let's just go back to what we said a minute ago. If you're buying a house now to sell in a year, I don't know that it's a great idea to buy a house.
I would
for
not
the
do
reasons that we just discussed. But if you're talking about selling your house after any period of time, the questions to ask yourself are, what are you going to do with the money? Why are you selling? What's your plan? If it's something you have to do, understand. If it's something because you think the market's going to crash or pull back or whatever, that's a whole different conversation to have. The question is, though, I mean, what are you going to do with the money if there is equity there? Do you have capital gains that you might have to pay by selling that property because you've made money and you've only owned it a year? Reasonable question. And where are you going to go? What are you going to rent? And if you're going to rent, what's it cost to rent? If you're going to move out of the area, what's it cost to live in the area that you want to be? If you want to buy another house, what's it going to cost to buy the other house? Does all of that make sense? Rates have increased substantially. Maybe you're in a point where you can't afford the property anymore. So there's a lot that goes into the idea of selling a property. So if you want to email me, be more specific on that. Maybe I can dive into it for you. But that's the easiest way. And I'll throw some information up here on a screen that will get you what you need here in just a minute. But before we dive into that one, Josh, there was somebody here asking
hold on.
No,
let me go first. I got to usurp this. You're going to like this.
No. Well, okay. Go ahead.
Well,
let me get this because it's trending across the bottom of the screen. Question: do you have in the Inland Empire? Do you have any recommended? Do you recommend any lenders? Yes, I do. I know that guy. I know several, in fact, but there's one I recommend. There's a link here at the bottom of the screen. Doesn't matter if you're in the Inland Empire or in New York and you need a lender. Click that link. I'll refer you to somebody, an expert that'll guide you through that process. So that was my take on that, Josh. Now, what did you have to say?
So Jeb was rightfully so very proud of his thumbnail today, and a friend of the show, Dan Frio, has piped in here to say you get thumbnail of the year.
I just thought it was good,
So you got the award for the thumbnail of the year for making.
Wow! All right, fantastic. What do I get?
What's the award? I thought I couldn't tell
Topo
because I
Chico.
did we get a sponsorship yet? I
No, but
looked.
you
I
got me
looked
a
at the.
Topo Chico, and I
I looked at
appreciate
the
that.
little thumbnail, Jeb, and I couldn't tell whether you made something out of Powell or if Powell was morphing into Walter White from Breaking Bad. So I liked it.
Hey, either way, good stuff. So a moment ago, let's see. So we got hide that comment. I mentioned if you need, if you're in an area, want to have a conversation with Josh, you're outside of our area, but you still want an expert opinion. There's a way to do that. That is by going to that link below. That'll get you in touch with Josh and or I. Have a consultation. It's not free, but it'll get you the answer you need. And also trending across the bottom is still that link to get you in touch with a lender. So that's where we're at. Been on the show 53 minutes. I haven't even asked for anything yet. So can you guys do me a favor? If you found any value, you want to punch me or Josh in the face, hit the thumbs up button.
We need to come up with a
That thumbs up,
virtual way
what it
where they can
does,
do that.
it actually signifies to Josh and I that you want to punch us in the face. And so do that. Hit that thumbs up. We're at 72 little thumbs. And guys, there's 317 people watching. So that either means a lot of people out there slacking, lazy, or maybe they just don't have a thumb. I don't know, but there's one on the screen you can push. With that being said,
did they give you the opportunity to put a different finger up for
us? you could probably put that in the comments, but I think Jennifer will be quick to get rid of it for us. So
Nightbot will say stop emoji spamming.
Exactly. So Al had a question at the beginning of the show. Said, "Hey guys, can I co-sign on a HELOC for my mom? She only has Social Security income, but lots of equity. If I co-sign, how and when will that affect my credit?" Thanks. So Josh, co-signing on somebody's mortgage, how does that impact their DTI if they want to do something themselves? And how quickly will that happen?
So two big and very different questions. So HELOCs are truly a portfolio loan. Most of the lenders keep those. They don't securitize and sell them. So they write their own guidelines. It's not Fannie Mae, Freddie Mac, FHA, VA, or some jumbo lender or investor actually making the guidelines. It is the actual lender on the HELOC. Many of them follow Fannie Freddie guidelines. Some don't. So you may have to shop. It may not be every lender that says yes, but you will absolutely find a HELOC lender that will allow you to co-borrow for your mother. So how does that impact you? It's going to show up on your credit report. You're going to want to make sure mom makes the payment on time every month. So I always tell someone, if you're co-signing for someone, don't let them make the payment themselves. Tell them, hey, I will co-sign with you. I want you to give me the money every month. I'm going to make the payment. Because
even mom, huh?
Even mom, you would not be surprised how many times I've seen family members get you to co-borrow.
Mom, I remember that one time you didn't pick me up from camp. I don't trust you. I'm making the payment.
Yeah. Well, I'm just telling you, I've seen it many a time. Sisters, mothers, aunts, they got co-borrowed for, co-signed for, so they qualify for their home and then failed to make the payments. And there's always a valid reason. I don't know that I've ever had one where it's just mom's a dirtbag and doesn't make the payments. There was a reason, something happened. But at least if it comes through you, you have the option of saying, Mom, I'll make the payment this month to spare my credit. But after 12 months, again, now this comes down to the type of loan you're trying to get. Fannie, Freddie, FHA, VA, they will accept 12 months of canceled checks showing payments from an account that you are not on, showing that someone else is making that payment. Now, for a mortgage, a HELOC, mom has to be on that loan. You couldn't borrow a HELOC against her property and then exclude it from your debts for qualifying purposes later on. As long as mom is on the loan, we can show mom makes the payments out of an account that is not in your name. So let's back up. I gave you advice to make sure the payment comes through you. Make sure you document and validate that the payment is made every month, because if you make the payment out of an account that you control, you will not be able to exclude that debt. So whatever you do, just have access to the account. If it's an online account, that you can log in the 1st, the 15th, the 25th of every month and make sure that payment gets made. But if you're wanting to borrow and it's going to mess with your debt to income ratio, if we want to exclude it, make sure mom, sister, aunt, brother, whoever is that you co-signed for is making the payments out of an account that you have no access to and no control over.
All right. So this one is a comment from a regular viewer here. Saying, I was ready to buy in 2020, watched a bunch of real estate doomers on YouTube while my best friends have seen 30+% appreciation. Lesson, if you're ready, buy. Yeah, that's what it comes down to. If it's the right time for you, buy. Be less focused on what people are saying you should or shouldn't do. I mean, we talked about it a minute ago, 5 minutes ago or so. If you're just listening now, go back and listen to that little spread, because it's important. It's important not to it's important when it's the right time for you versus when it's the right time for someone else. Next, Josh, pretty easy question here. Is there any loan system where I can pay on interest? Where I can pay only interest, but not principal for the first few years to reduce my monthly payment. So is there something called an interest-only loan that this gentleman may be able to use, or
So we've talked
female?
about
I'm
this.
not sure.
We've talked about this before.
Yep.
Definitely. There are interest-only loans out there. They fall under the non-qualified mortgage category, so they generally have a higher interest rate. So you don't necessarily realize all the benefit of the interest only because you're generally paying a higher interest rate. So run the numbers, have someone show you this is what a fully amortizing loan looks like. This is what the interest only looks like. For Fannie Mae, Freddie Mac, FHA, VA, you're not going to have interest only options. You're going to have to look to a non-QM portfolio lender, and you just compare the numbers. It's going to lower your payment some, but you're going to pay a higher rate of interest. So you're paying a premium for the right to have a lower required monthly payment. And Jeb, let's flash back to what I was saying. What do I love about my rental out there in Orange? $700-800 a month goes to principal. We talk about one of the benefits of owning your home is you are having a forced savings account, paying that principal down every month. As soon as you go interest only, you don't have that. So it's not to say it's a bad idea. It's not to say that it's the wrong tool. Every tool has a use, but it's sort of like you wouldn't grab a chisel and try to pound a nail with it. It's suboptimal. So make sure you're using it for the right reasons in the right time and place.
Good stuff. Sanders asking, do you see all cash offers decreasing in your area, California? So, I mean, keep in mind, I do on average about 30, 35 transactions a year. Not a lot for a one-person team. To be able to tell you what's happening with cash offers, kind of look at the National Association of Realtors data that they put out on some of this stuff. And it's remained pretty consistent. I think I don't remember what this past month was, but it was between 25 and 30% of the offers out there were still cash. So still a pretty good amount. And that's pretty consistent with what we've seen, but understand a lot, that data again, couple months old, with regards to, when those properties went into escrow and when they closed. Topo Chico makes you burp.
It's carbonated Topo Chico.
So with that said, I don't know. But what I can tell you is cash has always been a part of real estate, right? There's always been cash buyers, but what you have now is a lot of liquidity of people selling their homes, sitting on the sidelines, waiting. You got people that have pulled cash out of their property, willing to buy something else cash. You've got funds, institutional investors with cash. So cash is there. It's going to remain there. I can, if it declines, it's not going to be a huge decline. You're not going to see it go from 25% to 10. There's still a large percentage of cash in the market. In fact, I mean, the latest stats came out, and I think 38% of the people in the United States that own real estate don't have a mortgage. And that's up from like 31 or 30, low 30% from back in 07 during the housing debacle. So the number of people that own their properties free and clear, the amount of cash in the system, it's still out there. So,
and one of the things, Jeb, doesn't really directly relate to this question, but I always look at when you look at the numbers, when is it the Fed or the Census Bureau does the every 3 years they do an analysis of households economics, and what they always show is that homeowners pay less in a monthly payment than renters do, and it's usually by a significant margin. The reason is your grandparents who've owned their home for 50 years own it free and clear. Your parents who've owned their home for 25 years, they owe $100,000 on an $800,000 home. The only way to get those numbers working in your favor is to buy. So again, don't let anyone tell you it's always a good time to buy. You should always buy right now today. But as soon as it is the right thing for you to do in your life, you should buy and get that in your favor, because homeowners pay less for their shelter costs than renters do. And I don't know about you, I have zero interest in going into retirement with having to pay for the roof over my head. I mean, you're always going to pay your taxes and insurance, but I don't want to pay someone $2,000, $3,000, $5,000 to rent my home today. When we bought the house, it would have been about $2,500 to rent my house today. What do you figure, Jeb? $5,000, $6,000 a month
minimum.
minimum.
Yeah.
And
Yeah.
that's
I could rent your house.
$3,000.
I could rent your house tonight for $6,000. Do you want to rent it?
literally to live
Out.
in my house, it would cost me twice as much to rent as it does for us to own. And that's with, we've borrowed some money to invest in other things to fix the house up. If I had just stayed there and just stayed the course and paid the thing down, my payment would probably be half of what it is. Now we're talking 4 times as much to rent. So again, the last 20 years are not the best time frame to compare, but I'm telling you, if you buy today, in 20 years, you're going to have a much lower shelter cost than the person renting the home that you buy.
There was a question that came up earlier. I was going to click on it a little bit later, but asking the idea of Dennis here, might be a real estate agent, not kind of looks like his real estate picture. Maybe I'm wrong. Do you guys see us moving to a renter's nation? So you just said that, Josh. A lot of institutional buying and a lot of markets out there. Renter's nation going forward, or is this just a blip in the in housing for the short term?
Can I go on my political rant if I don't get
No.
one party or the other? Because it's all politicians do not give a shit about you or me.
Well, the
So
Topo Chico's got
they
you
are
crazy.
that's two wild ones tonight. So they take large amounts of money from the institutions that are making money acquiring properties and converting them into rentals. And don't take this as partisan one way or the other. The current party that is in the office, if you watch anything that they talk about affordable housing, they talk about affordable rentals. They're not talking about making it affordable for you to own a home. And I'm not blaming them for that, because I don't know that I have the answers for how to, in an open market economy, how do you make housing affordable, especially in densely populated coastal areas. But they're not even thinking about it. They're thinking about, how do we subsidize rents? How do we make rentals better? All the while taking political contributions from the big institutions that are buying rentals. So my answer is, people are always going to want to buy. And I think there's a lot of hand wringing and gnashing of teeth when we get to this point in the market cycle. It won't always be this way. Rates are not always going to stay this high. Prices, again, there's 2 ways for them to normalize. They can stay below trend appreciation for an extended period of time, or we can have a correction. I'm on record as saying I don't think we're getting a correction. My expectation would be we would have an extended period of below trend growth, and it will normalize as incomes come up and interest rates go back down.
Good stuff. We got Rain Yell saying, Jeb and Josh, great show as always. Question about HOAs, so homeowners associations. Is a neighborhood with an HOA a lot more stable when it comes to market correction compared to the ones without? I would say no. A neighborhood with an association isn't going to necessarily fare better than a house, the house without an association, unless the real estate is just more desirable to start with for whatever reason, location or newer builds or floor plans or whatever. HOAs are an acquired taste for many people out there. Some people will absolutely, despise the idea of somebody telling them what they can and can't do. While others, like me, I kind of like it. Hey, dude, you can't do that. Oh, great. We just eliminated John from painting his house orange down the street. That's fantastic. So to each his own. We've actually talked about HOAs in detail on the podcast. I know we keep plugging the podcast a lot, but there's a lot of valuable information there, guys. And it's free. Imagine that. Free information.
Free.
So go look at it. I mean, we talk about the pros and cons of an HOA. I wouldn't say declining market is a pro in that favor. Do you have anything on that, Josh? I mean, I don't think you disagree with that, but do you?
No, I'm 100% with you, but I do have a comment here. You'll find it hard to believe. I love the FJ Cruiser there. I'm not a fan of the Voodoo Blue. That there, Jeb, is
That's
Voodoo
where you
Blue.
Went. That's where you went with the comment.
I prefer Cavalry Blue, but I still love it. I like it. I like everything he's done with that FJ Cruiser. I would have just picked a different color.
Well, Josh doesn't really care what you think about HOAs, clearly. So he went with the car.
I said you answered the question.
Okay.
You killed it. Why would I add to the perfect answer to the question? I don't think there's really any reason why an HOA would protect values more than another area, unless you just had an area go to crap and there was an HOA neighborhood next door that prevented that. I don't see it happening.
All right, good stuff. Matthew is dreaming about Josh and I and has realized that watching too much YouTube is a problem. We can understand that. All we ask is you show up and just have us on. You don't even have to watch us. Just have us in the background. talking to your wife about the day, just have us on there. Just that we want to see what's going on. We want to know what's going on. Yeah,
I'm
but no,
I'm I'm
we appreciate the
hopeful.
support, Matthew. You're here every week, and we appreciate it.
I'm hopeful that the plot of that dream went like frame for frame with Beavis and Butthead do the universe, and I'll let you guys decide which of us is Beavis and which is Butthead.
That's so. I didn't see this, but Josh gave me
Oh, it's fantastic.
a breakdown of a scene in there earlier, and it was pretty funny. So I might have to go back and actually watch Beavis and Butthead, which probably the last episode I saw was sometime in the early '90s, maybe I'm mid '90s. Maybe did I watch it in college?
Late
Maybe college.
90s.
Maybe I watched
Late
it in college.
90s.
I probably watched it in college. Let's be honest. Had a
It's
couple
this
Topo
Topo Chicos.
Chicos and watched Beavis and Butthead.
It's the same jokes, they just never get old.
No, that's fair. So here is a question, one that you can't really answer because you don't know what her broker told her. But Anya, who is also a regular viewer of the show, appreciate you being here. Says, Josh, my broker gave me a quote on how much my taxes will change after purchase. Is it accurate? So I would tell you, if I referred Josh and Josh did your loan and he gave you that, I would say, yeah, I would say it's accurate because I know Josh knows what he's doing. So how I would answer this is, if you trust your lender and they're competent, and you feel like they're doing a good job, then chances are they're probably right. But in many cities out there, you can go look at what the tax rates are, and do the math yourself, right? If you know if your tax rate's 1.1% and you buying a house for, $500,000, you know that it's going to be $5,500 at, divided by 12. That's what it's going to be per, not 5,500, be 50, whatever. Anyhow, 50, yeah. Anyhow, yeah. So you can do the math, divide it by 12, and that'll get you your answer. But Josh, how would you answer that?
So here's the thing. I would say that literally by a 2-to-1 margin, even people in our business don't know how to calculate taxes.
Wow, you just went the other direction.
Most of you outside of California are going, what's the problem? You look it up and you know what it is. Prop 13 skews everything. I'm 99% sure Anya's here in California. So the issue is there's a percentage-based allocation. So when you buy a home for $600,000, the percentage-based stuff is simple, but then there's fixed also. So what most people in the industry will do is they will look up and they will say, hey, currently the taxes on that property are $600,000 a year, and it's a $400,000 valuation, so it's a 1.5 tax rate. And they go, you're paying $600,000, take 1.5% of that, it's $9,000. It's not the way it works, because a chunk of it is a percentage basis, and some of those are flat fees that will not increase even though your value is higher. So if they went out of their way to give you a number, my guess is they probably know what they're talking about. People who don't or are confused by this would just pass or defer on the question. So my guess is your broker knows what they're talking about. We use a tool from one of the title companies that actually does the work for us. My processor and I used to go and pull up the tax bill on the current property and do the math on our own and have a little spreadsheet to give to the underwriter. We actually have a lender that does the calculation for us, or a title company whose system does the calculation for us. And just so you guys know, in California, if you don't tell them otherwise, most lenders are going to take 1.25% for your property taxes, because statewide our property taxes are 1%, and then all those other little things, local stuff, whether percentage based or flat fee based, make up the difference. And what I will say is, over time, voters keep approving more school bonds, more road bonds, that type of stuff. So when I started in the business, for us in California, most areas were 1.08, 1.12. So we could save some money by showing the underwriter, hey, it's actually less than that. So it gives us some room in the DTI, and it makes sure that your mortgage bill, when it comes, is the actual right amount. Now we're seeing a lot more. It's 127, 135. Had a client that just got an offer accepted. We opened it today. They were at 1.41. So it's important to know. And the bigger picture, Anya, I don't know if he was telling you, hey, this is what our new taxes are going to be on an annual and a monthly basis, or if he was telling you what your supplemental tax bill looks like. When you close, for a period of time, you're going to pay at the current owner's tax rate. And eventually the county assessor's office reassesses you at the purchase price, and they come back and they say, hey, you underpaid us for 3 months, 6 months, 9 months at the old owner's tax rate. So if he gave you that, it's a little bit more complicated, but again, that tool we use from Fidelity gives us that number as well. It can give you a pretty good estimate of what you're looking at paying in a supplemental tax bill further down the line.
Good stuff, though. I wasn't expecting an answer that long for such a simple question, but you
She
got the
wanted that.
answer.
She wanted accurate
She got
answers.
the answer. So thank you there, Josh and Anya, for answering the question or asking the question. So Patrick says, why would you ever sell that property at 2.99? So he's talking about my house now. I talked about it earlier, especially in your location. That should be kept in an heirloom for the kid's family, in my opinion. I agree 1,000%, and that is the goal. But here's the thing is, because the interest rates are higher and the price of that property is over 3 times what I paid for the property I own now, the payment is significantly less. Can I make it? Sure, I can make it. Do I want to make it every month? Not really. That's a big chunk to bite off. So I'd rather have a lower monthly payment, be a little bit more comfortable. So that's the only reason I would consider selling it. I want to keep it, as I mentioned, but if we do decide to go that route, chances are the current property goes bye-bye, just to make it just a bit more appealing as far as the monthly payment, because that's what I'm focused on. I'm not focused on the price of the property. I care about the monthly payment. But anyway, let's move along. So James Schlong says, if you were to put 20% down on a house,
Beavis.
if you were to put 20% down on a house, how much does the house have to appreciate before you can break even or begin profiting from the sale?
But before you answer it, Jeb, just hack off the first part of the question. It doesn't matter how much you put down, what you have to gain to break even. So now,
it's less about the down payment and more about what's your selling cost. What is it going to cost you to sell that property? And you can find an agent out there that'll sell your property for 1% plus the other side. I mean, there's all different percentages. We're not going to talk about commission on here because it gets people in trouble. But the reality is you can get a lot of different variations with regards to commission. So what's it going to cost you to sell? I would say the average across the U.S. is probably 5 to 6% to sell a property. So you need 5 to 6% in appreciation to not necessarily break even, because you're going to be paying down the principal every month when you make your payment. But your goal here isn't to break even. So it's going to depend on how much your principal payment is versus all of these different factors. So there's not a clear cut answer, because you also got to factor in, you don't know what the market's going to do with regards to appreciation. How is the market going to appreciate 5%, 6% this year? If that's the case, then it's not going to take very long. So there's some different ways to go about answering the question. If you knew the future of where prices were going to be and we knew exactly how much you were paying towards the principal, it's a little bit easier calculation. But I would say, typically speaking, Josh, what's it take to recoup, if we go back average 4.6% or so over the last 50, 60 years, earlier you said 75. So 4.6% average appreciation over a year, about how much goes towards the principal.
You're going to pay down. You're going to pay down about 1%, a little more than 1% that first year.
Okay. So you need, on average, about a year and a half in that property to break even in an appreciating market. In a market that stagnates, moves sideways, going to take a little bit longer.
In the last 2 years, you needed about 6 weeks.
Very true. Very true. Let's see. Here we go.
And to that point, Jeb, you had a couple of clients who realized they bought a home they didn't like, and they profited in a very, very short period of time.
Did they? I've got 2 specific stories that people bought properties, and within a year and a half of selling those properties, they made considerable gains after paying any cost. And that's not normal. I mean, you got to understand that buying a property and seeing that, they got lucky. So don't go into real estate thinking that's going to happen, because it could very well be the opposite of that. MTB East. Question. I got a letter from my mortgage and was told I was overpaying by $700 a month. And I got a check for $8,000. Is this normal? So Josh, is it normal for you to be putting more money into an impound or escrow account and the balance coming off and getting that much money in return?
So every 12 months, at least every 12 months, your lender, if you have an escrow impound account, so if your taxes and insurance are included in there, they have to do an analysis and make sure that they don't have either too much or too little. Too little means less than they're allowed to by law to pay your taxes and insurance and have the pad that they're allowed to have. Too much means they have too large of a pad. So what happened here is somehow you have too large of a pad in your escrow impound account and they had to refund it. The only other option, I mean, the fixed rate mortgage doesn't change for 15, 20, 30 years, whatever the term of the loan is. The principal and interest are the same. So if you have an adjustable rate, it can go down, but it doesn't sound like that's what you're asking. So somehow they were over collecting for your taxes. Homeowners insurance, I mean, some parts of the country can be $200, $300, $400 a month for an average price home, but most parts of the country, it wouldn't in any way equate to $700 a month. So look at what they sent you and see where the difference is. See what they're saying, because what I will say is I have seen lenders screw up on this and they go, oh, hey, your taxes are actually lower, and they're misreading what they received from the county assessor's office. So they put it at too low of a level and they come back next year and go, hey, you owe us $6,000, or we can add $500 a month to your payment. So you do want to look at the documentation they're sending you and make sure that it is accurate. It's uncommon for it to be wrong, but it's not unheard of.
Good stuff. Al's got a quick question here. If a listing is back on the market and the last buyer hired a home inspector, does the listing agent have to show the new buyer the previous inspection report? Yes, they should. Any reports that were completed on that property should be disclosed to the new buyer. Do they have to? I mean, they don't have to, but it's against ethics and everything that go, it's that they should be doing. So
Jeb,
yes.
Wouldn't your Realtor Code of Ethics say, and not just that, but even the contract law, they have to disclose anything that they were made aware of through that inspection? They don't actually have to show you the inspection, but anything that comes up there, if they don't show it to you, it's much easier to give you the report than it is to say, hey, here's the 12 things that I was made aware of by that report.
Well, yes. And yes, you have to disclose it. But at the same time, you brought up something very important, is that if a buyer says, that is my report, I paid for it, you cannot give it to another buyer, then in theory, we can't. We could tell the buyer that there was another inspection, but that we're not allowed to pass it along, quite frankly. So I've had that scenario where buyers are pissed off because the seller wouldn't do the repairs that they wanted. And they're walking away from the transaction and saying, well, then you can't show my inspection report. Okay, well, that's fine. But I can read it to the other agent or whatever. I mean, the reality is, we should provide it. And nobody should keep you from doing that. But occasionally you get some people that are.
And Jeb, I want to ask a few questions. So I know the disclosure laws vary by state, but they're pretty consistent. Why don't you tell these guys the difference between what just when we're talking about the seller has to disclose anything they're aware of, and you go, well, how would you not be aware of it? Let's say a home that's been a rental that person's never lived in, and you'd have to live in a home to know some things. Maybe you just walk them through the differences between the two.
Well, here's important. So, sellers have to fill out do certain disclosures, complete certain disclosures in the state of California that says what they are aware of in a property, right? Most states have something like this. And so rentals, properties that haven't been lived in, probate sales, a lot of this stuff, sellers haven't been living in the property. Therefore, they're not aware of potential issues or things that could be going on in the property. Therefore, it's not disclosed. And the property could have issues. The seller's just not aware of it. And therefore, they don't have to disclose it. But this is important. Like me representing a seller, what I do, my sellers are never at home inspections. My sellers are never at these things where problems could be mentioned. Why? Because then my seller's made aware of it, right? And we're not trying to hide anything as someone that's representing a seller, but you don't know, like you could have the problem with home inspectors in general is that some home inspectors nitpick things that could be problems, may not be problems, and make them bigger problems. And therefore, the less my seller knows that they have to write down on paper that they're not even truly aware of what the problem is, but they overheard something. Now they have to mention that. that just creates the potential for more issues. So, I ask my sellers, do you want to see the home inspection report? It's sent to me. These are the items that they're asking for on the inspection. Do you want to see the inspection report? Some sellers are, yeah, I want to see it. I want to see about it. We have that conversation. Once you see it, that report is all stuff that you have to disclose. Some sellers say, no, I don't want to see it. I know my property or whatever. So there's, I wouldn't say, there's a lot of ways to approach that question. But, the conversation that I have when initially taking the listing appointment is there anything in your property that is a problem? Do you have any leaks? Are there anything that you've changed? Anything that you're aware of that a buyer would need to be made aware of? Is there anything in this property that, that if you were a buyer, you would want to know about? In some cases, the answer is yes. Yeah, we have a leak in this bathroom or whatever. Okay, well, we've got to disclose that there's potential water intrusion or whatever going on there. Or the answer is usually no. Most sellers don't have issues that they're aware of that they haven't resolved, because otherwise they're living in a property that's potentially unsafe and has other issues going on. So I don't know that I even answered the question, Josh, but the idea of disclosing things is that sellers should be honest and should be making aware a buyer of anything that they're aware of. But I will tell you, most sellers are not aware of potential. I mean, even if there are issues, they're not aware of it for whatever reason, just because the water heater's in a closet outside, the water heater's leaking. Well, we go open the water heater and say, dude, your water heater's leaking. I had no idea. It was outside. I didn't know that. Okay, well, that's fair. But the idea is try not to hide things. So,
yep.
Yeah. So anyway, I don't know if I even went the right direction.
No, I think it's helpful because people know, and I guess again, this comes back to California, but you have the seller property questionnaire, you have the transfer and disclosure statement, and then on top of that, we have the agent visual inspection. So really, why do we have 3 forms that are the exact same information? We are attempting to over disclose to the potential buyer any issues they possibly could be, should be, maybe need to be aware of, right?
Exactly. Could be, should be, would be. On a higher note here, better note, we got Doc Sharifa Clark coming in saying that thanking us for the knowledge that we provide. Closed on new construction May 16th in Dallas. Still watches the podcast or still listens to the podcast, watches every week. Thank you. No, thank you. Oh, we appreciate you being here. See, even doctors listen to us.
I need to screenshot that so I can prove to my wife that
exactly.
a doctor actually listened to something I said.
Too funny. But we appreciate you. So, Josh, good question here. D Terminator says, does it make sense to sell stock that has lost 20 to 25% in value to buy a house, which would be a primary residence? So is there ever a case? Let's just talk about selling assets to buy real estate. Is that a good idea? Is it a bad idea? Is it to each his own type scenario? What do you think?
Absolutely. You're deciding, I value this potential asset I'm going to acquire more than this asset that I currently own. So the red herring here is, does it make sense to sell the 20 to 25% loss? Do you have a time machine to go back and sell it and get that 20 to 25% back? Because your asset today is worth what it is worth. You don't know that it's ever coming back. You might have a hope or a belief or an idea that it's going to come back, but today it is worth what it is worth. So if it makes sense to own a home, and the way to acquire that home is to liquidate this asset, the fact that it's dropped 20 to 25% from its peak value is irrelevant. It just matters which asset do you value more. What are your thoughts, Jeb?
No, I think you're right. I mean, it's, this is not a reason to do that, but there's also a capital gains loss on your taxes that you can write off. It's not going to be the full, it is the full amount over a period of time, but there's a max per year that you can actually take on your taxes, not a CPA. If you need tax advice, go to a CPA or an accountant, just to be clear. But it is a loss, but it's, there are ways to recoup that over time in different ways. The question is it a better idea for you to own real estate right now? And if you find the right property and it makes sense to you to do that, I think real estate long-term is the winner. But if you were telling me, hey, dude, I'm going to sell my stock at a loss and I'm only looking to be in this house a couple of years, and I don't know that that's the best idea. I mean, the reality is we could see the stock market continue to move sideways to down in a recessionary environment that we're in. I mean, we're down 10, 15% off the highs. I don't even know where the market is, to be honest. I haven't paid attention to it, over the last couple of weeks. But why? Because I don't care. Because my money's there and I don't need it. It's like my house. I don't need my house to sell it. Therefore, I don't care about the value. So I don't know what the actual price of the S&P or the Dow or the value is at the moment. So you got to do what's right for you. It's not a straightforward question, but maybe talk to a CPA and see what they say. Talk to your financial advisor or planner if you have one, and see what they think about the market. I think that's really good advice.
In the meantime, Jeb, can we get you to regale us with stories of your options trading days of making millions of dollars in a day and then flushing it down the toilet the next day?
No, I don't, not really going there. Not because I'm ashamed of it or whatever. Just, I don't think most people out there probably understand what options are to start with. But if you understand options for, a couple years, 3-4 years, I traded options, on a regular basis while I was doing real estate. Kind of consumed me, did a lot of, investing in the market. An option is an opportunity to buy a stock at a certain price at a certain time frame. I mean, I don't know what the actual definition is there, but you can buy a lot more options than you can buy stock. I never traded on margin, which is obviously a good thing. But there were days where I made a lot of money and days where I lost a lot of money. It's an emotional thing. I'm greedy when it comes to making gains and some of this stuff. So making, a couple $100, couple $1,000 wasn't good enough for me. So I like to make a lot more than that, but I also lost a lot more, not a lot more than I invested, but it was never, I walked away with big money. So it was time consuming. I walked away from options. So
I don't know.
Now I just buy stock and I hold it.
I don't know that I would label
And I
you
add
as
to it.
greedy, Jeb. I label you as the person who doesn't know when to stop.
Is there a difference?
Just saying.
I mean,
Jeb
I'm the
is
guy that goes
that
to
doesn't know.
Vegas and I can be up a lot and I will sit there until I lose every bit of it. Not necessarily in the same sitting. I'll just keep coming back to the table over time. And I might walk away that trip with money, but guarantee the next trip I go back probably isn't going to be the same. So I like the exhilaration of money. I don't like losing it, but it's fun. It's all part of the game, man. Money's not that hard to make, people. It's harder to keep. That's the reality, Anyhow, let's talk about this. Josh, Michelin X22. It sounds like a gamer. I don't know. Heard about the idea of 1/3 of gross income for housing. Is that a requirement for a loan or just a recommendation? So if you make, let's give it an easy number, $6,000 a month. Is it the lender telling you can only spend $2,000 on housing, or is that just what Dave Ramsey's saying out there? And
There's
maybe not Dave
all
Ramsey,
sorts of folks talking about rules of thumb. And it's funny, over here in the comments, one of the questions we answered, someone said, well, the rule of thumb says this. Someone starts telling you about a rule of thumb, tell them to rip the thumb off and stick it in their ear, because most rules of thumb are 20, 30-year-old wives' tales that are not good for anything. And they were based, in fact, at some point, but not really today. So we kind of answered this question last week when someone said, hey, is this a reasonable debt to income? I make this much money, here's my other debts, and this is what my payment's going to be. That's really what the question is. So is 33% of your gross income going to a housing payment reasonable? For most people, yes, because what will happen is that will go down over time. Just like we talked about, your grandparents have paid for their house. Your parents owe $100,000 on a $500,000 property. The percentage will go down over time. Would I want to be 70 years old and paying 1/3 of my income to housing? Maybe, but probably not. We want that figure to go lower. But what I can say, we showed the chart last week, Jeb, and if you guys remember, I think it was 64% of California buyers are above a 40% debt to income ratio. So it depends on where you're at, what's reasonable. Most loan programs back in the 90s, 150 years ago when I started in this business, we didn't have automated underwriting. So you had
Dude,
to
you're
go
old.
way old, super old, almost 50. So we had to look up the guidelines, and it would say, with this down payment, here is your housing to income ratio, and then your total debt to income ratio. When we add in cars, student loans, credit cards, any other installment or revolving debt. For the most part, with automated underwriting, they look at a single ratio. Conventional loans, almost everyone with good credit can qualify for a 45% debt to income ratio total, including all the things that show up on your credit report. Well-qualified borrowers can go as high as 50%. On an FHA, borrower with reasonable credit can generally go to 47% housing to income ratio and 57% total debt to income ratio. So does that mean that those are reasonable numbers or things that you should do? You know your lifestyle. There's a million things that we do not account for in the debt to income ratio. You know, if you're the frugal person that eats top ramen at home every night, you can put more towards your housing than the family that decides they all want to go out to Chili's every night and have, you know, fajitas and fancy stuff like that. So really, a lot of it comes down to your discretionary spending on what doesn't get accounted for in the debt to income ratio, and also what your tolerance level is. I've talked to people that I could tell you they would have been in a cold sweat if we had closed them at a 33% debt to income ratio for their housing expense. I've also talked to people or closed people. Jeb, our best example is Jeb and I have a joint client that bought a condo here in the Huntington Beach with a VA loan that had a 71% debt to income ratio. That made me wake up in the middle of the night of a cold sweat. He don't care, and he's made a bunch of money on that property in the meantime.
And that was years ago. But anyway, you said two things. One is that fajitas are a fancy meal. It's questionable.
Listen, in
Hold on,
Kinston,
hold
in
on,
Kinston, that's an anniversary meal. What are you talking
dude.
about?
In Kinston, that's fantastic
You have to
meal.
drive to the big city to get
We
fajitas
we
from
didn't have a
Kinston.
Chili's, bro.
Exactly. So
So
what are you
now you're
talking about?
Golden
Don't look
Corral. Golden
don't
Corral
look down your nose.
was the
Exactly.
nicest restaurant at that time. Since then, it's changed. For any of you those of you who know, from Kinston, I'm from North Carolina, rural town, small. Grew up there my entire life. Moved to California when I graduated college. Nevertheless, that's not what we're talking about. Second thing is, I forgot to mention Josh's birthday was last Thursday. Should have mentioned it on the show Wednesday. Completely dropped the ball. I don't even know that I've actually said the words "Happy Birthday." So, Josh, happy
He
birthday.
doesn't he doesn't like me, in case you
He
didn't know.
mentioned almost being 50. For any of those who missed that, he's almost 50 years old. I mean, look at that guy. He looks not a day under 62.
Not a day over
You look like
48.
you could get retirement. I mean, AARP, pull some Social Security, that sort of thing. But dude, you're still here, kicking.
We're alive. That's all. Every
We're
day
good
above
stuff
ground. Every day above
every
ground is a
day.
victory.
So we're at that point where I'm asking a favor. If you'll hit the thumbs up, subscribe to the channel if you're finding any value. Do this every Wednesday for 2 hours. I don't know how many episodes. I need to go back and see how many weeks have we missed this year? Just one?
I think one.
One, and we're 26-ish weeks in,
I
give or
may have
take.
missed two. I was out in
Yeah,
Mexico, and then we
you
had the
quit.
1 week.
Yeah, you gave up on us. But
No,
26 weeks. So we've been 25 weeks, 2 hours. That's 100 hours of content that we've provided to you guys. So do us a favor, hit the thumbs up. If you like us, if you don't, hit the thumbs down, leave us a comment, whatever it is that satisfies you. There's a referral link in the bottom, scrolling across the bottom, that will get you in touch with a lender and or a real estate agent anywhere in the country. And lastly, if you want to get in touch with Josh or myself, and you're out of area, want to have a consultation, there's a link for that right there. So do that, hit that, all good stuff. We appreciate you being here and appreciate the support. So we're going to return to some questions here. We got some easy ones that I'm going to click on real quick just to get through some of these things. And Jacqueline came up and asked a question, real estate agent in Phoenix, asking where I'm located in Huntington. So I'm down by the beach, essentially. So reach out while you're here. Send me a text, and if I'm available, happy to meet. If not, You can text or call me.
I
We
see.
can
I see.
figure
You
that out.
guys are going for ranch waters and not including me, and I feel bad about this. I don't
You
know
never
what.
know. Topo Chicos is where we're going.
And it's a different spelling there, but I got excited for a minute. I thought the Jacqueline Smith
The Jack,
was
yeah.
actually going to come and have lunch with us.
Us now. Wow,
I
we've
invited
multiplied.
myself.
We are
I
all getting,
invited
it's all a
myself.
party, guys. So anyway, let's talk about this one. We've got I just saw the question and I've quickly moved along. Where was it? So Jacqueline, anyway, hope that answers your question. Ariel has a question. I'm an S corp, so a type of corporation. You can be a C corp, you can be an LLC, you can be an S corp. Just a different way of holding the type of business that you are, if you're unfamiliar with that. But wondering, what are all the home tax deductions I could get for my home if I use one room as an office? Now, before Josh talks, I want to be clear. No
We are
accounting,
not tax advisors.
no accounting degrees, no CPA degrees. In fact, a lack of all of that to some extent. Not entirely, but just being facetious to make sure you're clear that we're not tax advisors. But Josh, what can you write off? You can write off internet. You can write off the office itself. You can write off, which would be a portion of your mortgage, I assume, right?
So
You
here,
can write off
here's
telephone. Let's
here's the
hear it.
here's the funny part. For an S corp, for us, when qualifying you for a mortgage, everything gets mushed into the categories on that first page of the 1120S.
Yep.
Now, where we normally see is the home office expense for someone who's not incorporated on a Schedule C, which it kind of lumps everything together. So again, much like East Carolina University, where they don't even offer an accounting degree, I'm not sure if we had them at Eastern Washington University. So on polar opposite coasts of the United States, Jeb and I are probably not the best person to answer this, but he's on the right track. Anything that you can show is an expense related to the business, including the home office expense, whatever utilities are allocated in a portion to that portion of the home. But the most important thing is talk to your tax preparer. If you're doing it yourself, maybe find a tax preparer YouTube channel where they go into detail on this.
Good stuff. So Topo Chico, if you're unfamiliar with it, which I was prior to an hour and 39 minutes ago, is very carbonated. It will make you burp. So if I'm burping into the microphone, I apologize, guys. This is something Josh, for his birthday, wanted me to celebrate. I'm taking into, so I decided to do it to appease Josh.
Normally we do 805, but we're going low cal.
805 would have been a better
Low-cal.
deal, I think. But anyhow, Ashish says, just closed on a house in Lathrop. Lathrop. Are you guys seeing aggressive correction or 5 to 10%? Nothing at the moment. I think you're seeing more sideways moderation in prices. As I mentioned earlier, I think you're going back to pricing homes where they were, back in January, February versus where they are in close dates in May. And you might say, well, Jeb, you can't do that because that would be a decline in prices. No, I mean, look where prices appreciated to that point. You've got to look at all the data, but I don't think you can't look at where the last sale closed and say, this is the value of this property in many markets. In some markets, you can still do that because the properties that are just closing now went into escrow a couple months ago. And since then, the market has moderated some. So would you say that there's been a peak in prices? Maybe in some markets you have, but there's still many, markets out there that are continuing to appreciate that because of the low inventory, the demand, the lack of certain opportunities or options in housing, the markets will still appreciate. It's just going to be less appreciation. You're not going to see, like we mentioned earlier, the Case-Shiller came out at 20%. You're not going to see the 20% year over year now. It's going to be lower numbers going forward. So don't expect big declines, but at the same time, don't expect big appreciation. And markets that were less desirable prior to the pandemic are probably going to remain. I mean, those are going to be affected a little bit sooner, or quicker or more with regards to house pricing than those that were stable and very desirable to start. I don't know where Lathrop is exactly, Josh. Central California somewhere, maybe? I have no idea. Or is it above San Francisco? I have no idea.
I'm going to use my Google machine, and I'm going to tell you, I don't think it's north of, but again, I wouldn't bet my life on it.
So anyway, some markets are going to have a bigger price appreciation or a price deceleration than others, but I don't think you're going to see 20. I mean, somebody posted 15 to 25%. No.
Jeb,
No.
it's right near Manteca.
Where the hell's that?
It's just south of Stockton.
Know where Stockton is, so that gives me a little bit better reference.
It looks like it's about halfway between Stockton and Modesto, so you're fine. It's in California, and all the Bay Area people who can't pay $2 million for a 400 square foot apartment are moving to Stockton and Manteca and Modesto.
Well, there you go. We just learned something. Tiffany says, can halfway houses devalue your property? Owner in my neighborhood bought another property and is renting her house. It looks like the owner turned her property into some type of halfway house. So the easy answer is yes. Yes. Anytime an owner turns a property into something like a halfway house or what have you, it can affect the values around it if people are aware of it. And there's discriminatory, there's a lot of different things out there where I'm trying to get my thoughts together that can keep you as a listing agent from actually disclosing that fact. So unless you know it to be true, even if you know it to be true, there's certain things a listing agent can't tell, and or a seller is not supposed to disclose about a property down the street because it discriminates against them, which in turn creates a whole other issue. But if you've got a property that the halfway house would be more of an issue if there's issues being caused around that property. You know, they're violating noise ordinances. They're a bunch of cars parking on the street. They're not taking care of the property. They're overgrowing it. There's people outside sitting on the front porch smoking, like that sort of thing is more of a concern for potential neighbors and buyers than the fact that there's a house down the street that is some sort of rehabilitation property or what have you. But I've sold properties in neighborhoods that have had these before and talked to attorneys through, our association and been told that we can't even disclose that sort of thing because of because of discriminatory stuff and all of that. But I don't know if I answered the question directly, but yes, and or no, depending on who knows about it and what can be told about it and what those people are doing that neighbors don't want to be around and what have you. So Josh, anything you want to add on that one?
No, I'm
rambling a little bit over here.
No, you're all over that. I'm a little bit removed from it, but I know that it sounds crazy. You would think that of all the disclosures that we have to make, that this would be something that would be disclosed, but it becomes a privacy issue. And most of the lawsuits have been settled in ways that don't seem there. They seem to fly in the face of logic, I should say.
Yeah. So, I mean, here's what I will say. There is one downtown that I'm aware of on a street where I have two friends that are located within 3 or 4 houses of that. If those houses were to go to sell, neither of those property values would be affected by the one down the street because, quite frankly, no one knows down the street that that's actually what it is. And no one can disclose it because of the privacy stuff that Josh just mentioned. So in that case, it wouldn't be, but it's one of those things where, you want to make sure people know, but there's certain things you can and can't do. And so, I don't know. It's questionable, but we talked about earlier about HOAs. This is something that, having an HOA is a good thing because it can keep things like this from potentially happening based on the way the CC&Rs, the bylaws, and that sort of thing are written. Not always, but in some cases, that's why there's benefits to having it. So we'll move on. What do we got here, Josh?
This is a version of the question that we had last week, but why don't you give a quick one on this one?
Question: do you recommend doing a price reduction or removing and then relisting? Also, is what's the second half of that, Josh?
I don't think it ever got posted.
Okay, so it depends. How long have you been listed, for one? In many markets out there, in order to take a property off the market and relist it and it not show the cumulative days on market, In my market, that's 90 days. It has to be pulled off the market 90 days in order for those days on the market to reset. So do you have 90 days? Do you want 90 days? How long has it been listed already? Those are important questions. Second thing is, are you going to go with the same realtor to start? If you are, I mean, things are sitting a little bit longer. I mean, so the fact that if it's been on the market, it's hard to give you a day reference because each market's a little bit different, but I would tend to lean towards doing a price improvement. Notice the change in language there. Sounds a little bit better than the price reduction, but doing the price improvement to keep it on the market. Right. I mean, here's the reality is because of Redfins and the Zillows and all of the data that's available on the internet, the buyer that's looking at your property is probably going to be looking at one of those sites and can see that you had it on the market for X price. Even if you relist it, they can see that it was listed at X price however many days ago. So you're not really fooling anyone because the information is readily available. But I would probably just go with the price improvement and try to get it sold if that's your goal. So hopefully that's helpful. Josh, we got somebody asking, is it a good time to buy a second home? So I actually saw a stat today that the second homes being purchased have declined. Let's see here. I don't know if I actually have the number, but it was basically second home purchases have declined significantly. Is that because there's less people out there wanting second homes, Josh? Or is that because the cost to own a second home with regards to financing and some of the things that have been put in place, along with rising rates and along with home prices, have just kind of put brakes on that sort of thing? Maybe talk a little bit about how interest rates have been impacted because of the adjustments that have been made.
Let's talk about the elephant in the room. Is 10 years ago, there was no Airbnb, no VRBO existed, but not really at the scale that it does right now. So why was this explosion of second homes? Because people realized you could put them on these sites and offset your cost. Whereas the average American 10, 12 years ago couldn't say, I can have an extra home for $200,000, $300,000, $500,000, $600,000, $1 million. Now they look up and go, not only can I have it, it might be a profit center and bring in some money for me. So when you look at that, what we're starting to see.
Sorry, Josh, just quick. Here's the graph I was talking about earlier. So demand for vacation homes, typically second homes, fell below pre-pandemic levels back in May. So and it's because of the things that Josh you're talking about right now.
Well, that's a piece of it. Just the pandemic itself, people were like, hey, if I'm going to work from home, if you have to be at the office 5 days a week and you can only leave Friday night and you got to be back Monday morning to go to your second home, that is a pretty limited window, right? What if I only need to be in the office 3 days a week and I can go to my second home for 5 days? You know what I'm saying? A lot of people have that luxury now that they didn't have before. So there was a big spike in demand. Interest rates were really low. Who buys a second home? It's not a first-time buyer. It's someone with good credit, assets. They got a chunk of money in the bank. They're looking to invest, looking to diversify. So with that, now that we see the big portion of those gains behind us with the outsized appreciation of the last couple of years, that would be expected absent the giant spike in interest rates. Now we have a spike in interest rates just in and of themselves. If you guys wanted a good laugh, we should pull up and price a 10% down second home right now.
Or like videos that Josh and I filmed back in 2012.
That would be a good laugh.
But anyway,
we still didn't get any answers of which is who's Beavis and who's Butthead. I'm disappointed.
I could be Butthead. I mean, that's essentially what my kids and wife think of me. I'm a Butthead, so I'll be Butthead. You be Beavis.
So yeah, I'm pretty sure that Beavis or the Butthead's the alpha of that group. So let's go back. So the thing that you were talking about that no one really talks about, in January of this year, if you put 10% down on a second home, you were getting the same interest rate that the guy did who was putting 10% down and buying that as a primary residence. Now there is a more than 4-point hit for that. You say, what is a 4-point hit? It's a loan level price adjustment where you can pay 4 points out of pocket, 4% of the loan amount. And I hear all of you going, yeah, no one does that. Correct. So in a normal market, that would be a 1% increase in rate. Well, we're not in a normal market. Lenders already have rates high and they're worried about prepayment risk. Higher note rate loans are more likely to prepay. So really you're looking at a percent higher rate and paying a point or 2 points just to get it, because a lender won't pay a premium to cover all of that loan level price adjustment, which probably doesn't mean anything to you guys other than rates are massively higher. Loans are much more expensive. Rates in and of themselves are higher, and lots of these areas are changing the rules and regulations. I own a second home in Rancho Mirage. We rent that property out on VRBO. We always had the ability to do it as short of a time period. One night we want to rent it to Jeb and his family, no problem. Now 28 days is the minimum that we can rent to someone for. For us, it's not that big of a deal. We paid the property off. We own it free and clear. I really just need enough money to come from that to cover our HOA, property taxes, and maintenance and upkeep. But the person who bought that as an investment and now can only rent that for entire months and is more likely to have bigger gaps in entire portions of the year where that thing sits empty, that's going to impact people's desire to own those properties. And that's what you're seeing in that chart. All of those things coming together and impacting that.
Good stuff. Good stuff. So we got a question here. Let's see. We got dancing alone with rentals. How would you sell a group of homes? Do realtors assemble a portfolio and circulate that to buyers? Potentially. There's a lot of different ways to potentially sell a group. I mean, if you're looking to sell them all as to one mass, I mean, all in one mass to one particular person, we would essentially try to find some sort of investment group or individual that's looking to put that money to work. So yes, which brings me to something I honestly, Josh and I have been talking, and it's something I wanted to ask you guys, and I don't know that we're going this direction, but it's something Josh and I have brought up. Is anybody out there in this group? There's 256 people listening. Is there anyone out there looking to invest in real estate as a group? Not like a micro shares type thing. But if every investor put in a certain amount of money and went and bought, a portion of properties, a group of properties, if you will, a portfolio of properties that brought in a positive monthly cash flow, is that something you'd be interested in? If it is, I'll put my information up here on the screen in just a moment. Josh's information. You can email us and let us know. Something we're thinking about doing, and we'd have money invested in this, guys, is equal amount as you, maybe more. So we're not looking to, go crazy here. And obviously there's rules and all this other stuff, legal jargon that we should probably put up. So we're not asking for money, but we're just asking if there's any interest out there. So.
And really, Jeb, the genesis of that conversation is I have several clients who've come from the show who we've done purchases, we've done refinances for, and they're like, I have a chunk of money and I've got priced out of rental properties in California. So they've got $40,000. They got $140,000. They got $80,000 that I will say, I think I've told you guys from 2008 to 2011, 2012, we flipped about 40 houses. And my biggest regret is just using only my money versus going to people who didn't have the skill set and the industry knowledge that I have and saying, hey, do you have a chunk of money? We could do 120 houses and we can hold a bunch of them versus selling them for income. So really what we're talking about is becoming the hedge fund. And instead of saying, hey, we're getting priced out, we can't do this, we can't buy investment properties, there are markets in the country that cash flow is much better than California, although appreciation is probably not going to be the same as it is in California. So acquiring a portfolio of properties that generates cash flow is what
we're trying to become your competition, is what Josh is saying. We're becoming your competition.
Only so if you're in some either of these,
jump in or we're
lower priced backwater areas.
No, it's so if it's there, reach out. Obviously, conversation. There's a lot that's got to transpire for that to happen, but there's conversations about doing something like that. On a side note, Mr. Matty came in and gave a $10 super chat. Thanks, Matt. I don't know if you own a house right now. You sold your house. I don't know where you're at. Let us know. I know you're thinking about buying something in Vegas. I don't remember exactly. So there's that. Obviously, Beavis and Butthead do the OC. That could be good. Beavis and Butthead do the OC. This is good. Jeb is Beavis. Josh is Butthead. There you go. I don't even remember who's who, to be completely. I remember what they look like, but I Don't remember because I haven't been doing that.
Listen,
Uh,
any of you guys that have Paramount Plus, it would actually be worth subscribing to Paramount Plus. If you have any
oh
joy or
God.
take any chuckles from Beavis and Butthead, that first 40 minutes of that movie made me laugh. It was funny.
There you go. So here's the question we're going to end with, Josh, tonight. If home prices decline, what is the most likely range? 0 to 10% or larger? Now, I kind of addressed this a moment ago. Real estate's local. It's going to be different depending on what market you're in. But I'm going out on a limb and saying 10% towards the higher end. But I don't even know that that's in the next 12 months. I mean, I don't know when that happens. I mean, I think at some point prices do have to pull back, but what levels do they pull back from? You could get higher than that, but here's what I would say. Please understand, 2 years, we saw nearly 40% appreciation in 2 years, people. So if you saw a pullback, say you saw a pullback 20%, where does that take you? It takes you to 2021 prices, somewhere in early 2021. We saw, well, Case Shiller, here's a perfect example, just came out and said a 20% price appreciation year over year. And that took you from February, March, April, I think were the 3 months. So going back 2021, 20% less still has you 20% more than you were prior to the pandemic. So could you see 20%? Maybe to some normalization, but I don't think that's realistic, especially in the short term. Josh, I'll let you wrap this one up.
I'll go back to my book, Thinking in Bets. What if you're assigning odds to it? What would you be willing to bet? I would say somewhere in the 60% range. I don't think it goes negative at all. Could we see an extended period of very little 0 to 4% appreciation? Yes, that would be my most likely case. That 0 to 10 would probably be my next chunk, which I would say is probably another 30%, 35%, somewhere in that range. And then more than 10% would be very unlikely just because of the economics of where we're at. I think it is much more likely to have a protracted, flat, very low appreciation period to get back kind of in line with what the normal affordability figures look like. And I also do feel like, again, along that lines of what am I willing to bet? I think we got a 2-to-1 chance that rates are a good bit lower this time next year from where they are. That's the only factor in the affordability equation that is likely to move in favor of supporting the market. So if rates go, I mean, I'm not saying that we're going to go back to 2 and 2.75 or even 3.5, but if the average rate for a really good borrower is 5.25 to 5.75 right now, if you go to 4.25, that's supportive of the market. It brings a lot more people back into the market in terms of able demand, not just willing demand. And to the flip side, what would change my equation? What would possibly push it more than 0 to 10%? It would be rates moving significantly higher from here. If rates somehow wound up at 8.5 for your best qualified borrower,
I'm going to
prices
punch you in
have
the
to
face
come
because you
down.
told me they wouldn't go that high.
That's a good idea. That's a good idea. You might have to catch me because I don't know. I'll be selling used cars over on Beach Boulevard.
All right. So there's our answer, guys. 2 hours tonight. Do us a favor, hit the thumbs up, subscribe to the channel if you're not already there. We're here every Wednesday for 2 hours, typically every Wednesday, to answer your real estate and mortgage related questions. We appreciate the support. You can find us on the Educated Homebuyer podcast, any platform you choose to listen on. Today, we actually did an episode on mid-year forecast for the rest of the year, kind of give you where we think the market's going to end up. So check that out. And lastly, if you need a referral agent, real estate agent, mortgage professional, expert anywhere in the country, check out that link below. Josh, I'll let you summarize and finalize as we move out.
I'm gonna leave it with the most important comment of the night. Jacqueline Smith says that she would love to connect with both of you boys.
Dang it. She also
I
says,
successfully invited myself into the
and she says
conversation.
there's a potential for investment there. She got a syndicate. She got some people that's looking to invest. So, Jacqueline, we appreciate you being here. We appreciate everybody being here. In fact, we will see you guys soon. Adios.